The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Welcome to our Bursa Malaysia webinar today. And today, what we're going to talk about is the science of buying and the art of selling. And with me, we have David from Spiral Thinker Alliance. Thank you so much, David, for
Hi,
joining us
Chen.
today.
Yeah, nice to see you again. Thanks
All
for having
right.
me back.
So, yeah, before we begin, just want to check if you can hear us, if you can see our screen and hear our voice clearly. Can you please click the raise your hand button from the control panel? If you can hear me and see our screen, please click raise the hand button. All right, thank you very much. You may put down your hands right now. All of you here can hear our voice. Okay, great, excellent. You may put down your hands right now. And we are very grateful that you all registered for today's webinar despite the Raya break. I think today we have overwhelming response for this topic. I think many of you will want to know when is the right time to buy or sell and what is the uh, logic behind the buying and the selling decision. So a lot of you tune in today. We have overwhelming response. Hopefully, it will not be full house today, so most of you here can still tune in later. Now, today, before we begin, just want to talk about disclaimer as usual. Whatever the speaker share with you today, we do not give any buy or sell signal. So if you decide to buy or sell anything, you do it at your own risk. Okay, you're financially responsible for all your buying and selling decisions. So now, Bursa Malaysia has designed a series of webinars. So for on every first Tuesday of the month, that is for our beginners to tune in. And today, the topic is the science of buying and the art of selling. And next month, we'll be talking about chart pattern masterclass, where we talk about basic indicators and basic chart patterns. So if you are a beginner, you want to receive more elementary kind of education online, please reserve and block every first Tuesday of the month for us. And on every second Tuesday of the month, we will have a Chinese webinar series. So if you want to learn, from the Chinese, you want the content in the Mandarin language, please tune in on our every second Tuesday of the month. And on every third Tuesday of the month, we will cover a bit more intermediate to advanced topics. And for this month, for example, we will talk about technology-aided stock trading, how you can use technology to do stock trading. It will be done by CC Yong. So, and without further ado, let me introduce our speaker today. And David is the founder of Spiral Thinker Alliance. I have known him for a good number of years, and he taught me a lot more about value investing, portfolio management. And today we have him back with us on the Bursa webinar series to share with you how you should buy and how you should sell. And David do not have a financial degree.
Nope.
He started his degree as an engineer. As you see, you don't need an accounting degree
Nope.
to become an investor. And he started his career as an engineer in the telco industry for 10 years before venturing into the value investing sphere. He served as a director in a local equities education and research firm for 3 years, managing research efforts and delivering advanced value investing and portfolio management education series. And thereafter, he left and he pursued his own aspiration, establishing the Spiral Thinker Alliance, which is a collaborative alliance to promote intelligent value investing. Not only value investing, but intelligent value investing, and develop algorithm-based adaptive portfolio strategies for sustainable and long-term wealth creation. Now, today, David is a full-time investor and he dedicates his time and resources to nurture the youth, okay, like me,
everyone else.
Which are probably youth at heart, okay, and in financial literacy. And he's also often invited to speak in a brokers webinar. I think I've seen you in many brokers webinars, seminars, and also on Bursa Endorse program, where he also write for Focus Malaysia, as well as providing consultant service to high net worth individuals, private investor.
Yes.
All right. So without further ado, David, tell us what you're going to share with us today.
Okay, first of all, thanks again, Chun Sian, for having me back, as well as LifeChamp, as well as Perusahaan Malaysia. I think this is a very good education series. In fact, I wish that during my time we have things like this.
Yeah.
Otherwise, then I would have lost so much money in the stock market before. Yeah, okay, but jokes aside, today the topic of my seminar or webinar will be the science of buying and the art of selling, which is in a way like a continuation from our previous webinar on introduction to portfolio management. Yeah, so the agenda for today is very simple. It's just very we start off a little bit with introduction. Then we lay out the grounds for you guys by talking about how to set your goals first, and this is very important first step. Most of the people, when they talk about investment, they straight away jump to the stocks, click the buy button, right? But we have a specific set of procedures that you can follow before you even buy your first stock. Then after that, we will jump to the core topic of tonight, which is the science of buying. And there will be a lot of sharing as well as a lot of details in this topic. So please bear with me if you think that it's a bit more advanced. Maybe you can shoot your questions to Chun Sian later on the webinar. After that, we talk a little bit about the art of selling, and last but not least, we close the topic talking about a little bit about how to rebalance your portfolio towards achieving your target at the end of the day. Yeah. So this is basically the introduction, a recap on the essence of portfolio management, which we have done, I think, last year, December. Yeah. So just to recap, these are the four main topics that we talked about last time. Why we need portfolio management. All right. What are the concepts, the key concept, as well as how to construct a portfolio. Then we move on to the basic parameters that you need to know or you need to calculate or to track when you have your portfolio. And last but not least, we talk a little bit about optimizing the risk and performance, which is like a prelude to what we are going to talk about tonight. Yeah, the key takeaways from the previous webinar, very simple. We talk about why we need portfolio, which is basically to manage your risk by managing your capital exposure to certain industry or how to diversify into different sectors. Then there's a very important part about how to assess your performance over time, tracking your goals and see whether you are on track or you are too far from your objectives. Then what are the mitigation steps that you can take to rebalance, as well as other improvements that you can do so that you can get back on track to achieve your goals. Yeah. So today we see previously is talking about more on portfolio construction, okay, and parameters that we need to track. So tonight we're going to move on a little bit to the execution part. Yeah. So the top is about the science of buying and the art of selling.
So may I ask you, David, this question? Why do you name the word science of buying, and why do you name the word art of selling?
Yeah, it's actually a very interesting question. I was hoping to catch your attention with this title. Yeah. Sounds very mysterious, right?
Yes.
Yeah, actually, when people know about science and art, science is like you have a specific steps, procedures to follow, rules, right? Art is like this is whether you appreciate this art or whether I don't appreciate art is matter of preference, personal preference. So in this regard, in the angle of portfolio management, right, we have a very specific steps to actually help you guys start the buying part. So there are steps to follow, parameters to help you buy better. Okay, but when it comes to selling, it's more of a personal,
It's more subjective.
You're right.
So when it comes to science of buying, it's more objective. Yeah.
Yes, you're right. It's
Proven.
very objective based.
Yeah, it's a proven methodology, what step to do.
Yes, you're right. So for example, when I want to go into a stock and raise 20%, it went up. To me, it's good enough. I will sell. But to you, because you are younger, your risk appetite is higher, your required return is higher. So I say, David, no, I'm not going to sell at 20%. I'm going to sell at 30%. So and the next guy can have a different, maybe 10% is good enough for me. So that is why selling is more of an art. Yeah. But for tonight, I'll be focusing a lot more on the science of buying.
A lot more on science of buying.
Yes.
Okay, which will walk us through what are the logical rationale behind
Yes.
of the purchase of
Yes.
stocks.
Yeah. Okay. So to start off, before we jump into the science of buying, right? Actually, this is a very important first step that you must have, which is setting your goal. We talked about this in the previous seminar, but here I would like to supplement a little bit with a bit more details as well as steps that you can do. Underscore, right? Setting your goal is the very crucial first step in any investment plan, whether it's stocks or properties or other asset classes. Yeah. So let's jump straight away to the topic now. Before we begin, right? Most of us, when we talk about stocks, we straight away see, okay, I've got trading account now, so what should I buy today? But that should not be the case if you're talking about long-term investment. Now, the very first step you have to do or to decide is your main objective of your investment. What is it for? Now, normally when I talk to students or to clients, they say, okay, this is for my retirement fund, for my own, all right, because EPS is not enough. And a large group of people, when it comes to me, they are more concerned about the inflation of education fees, cost of education in the future. So want to set up one specific portfolio for their children's education. Some people may want for very short-term gratification, all right, capital gain,
Buy
so on and so
car,
forth. Yes, you're right. Or buy house, or to have the down payment for the house. Yeah. Then why is this important? Because knowing your objective, it will subsequently impact, all right, how much money do you need to invest today, your initial capital, right? Then it will also impact, or it will have a bearing on how long should I invest. Now, when you put these two together, then you arrive at what kind of KGAR target that I should be aiming. Now, for those of you who are actually listening to me for the first time, KGAR stands for compounding annual growth rate. So it's the annual return that you should be looking at, or you should be targeting based on your required return, your capital, as well as your investment tenure, right? And most importantly, is this top part, risk tolerance.
Risk tolerance.
Yes, or in other words, your risk appetite. For example, just now we talk about a very simple scenario where your risk tolerance or your risk appetite is different from mine, and mine is different from the next person. Yeah, so these are very personal things. That is why there is no one generic way to construct or to manage your portfolio. It depends on our personal requirement as well as personal preference. Okay, now so let's talk a little bit about the KR target. So just now I talk about buy a car, right?
Yeah.
So very simple. Now, example, if I know there are a lot of youngsters among our viewers today, so I think I'm quite sure there are a lot of the viewers who just started working. Yeah. So normally when youngsters start working, what is the first thing that the big ticket item they want to buy?
Get myself a car.
Get yourself a car, right? Now, of course, it would be nice, if you can. Most of the people will actually take a loan from the bank to buy a car, right? Now, let's say, just for hypothetically speaking, that you plan to buy a car, maybe a nice car, a sedan worth 100,000 in cash. So the keyword is in cash. I don't want to take any loans, but I allow myself 6 years to accumulate the 100,000, right? So as you can see from the slide, so I put a icon there, is financialcalculator.com. This is where you can get some free app.
I have this app.
You have the app. I think, in fact, any investor should have an app in their phones, right? So this is a snapshot of how the app should look like. Now, say today, since you are just come out for work, I'm sure we should have some savings in our bank account, right? In fact, if you have not spent all your ang bao monies, which you accumulated over your years as a kid, as a teenager, right? By right, typically on average, you should have about 20,000 in your bank. All right, so let's just assume we have that tip of our average person. Now, because you are working, all right, so any financial guru will tell you that you should put aside some money for investment, all right, other than after your expenses and all other commitments. Now, just hypothetically speaking, say we're going to take 500 ringgit every month from our salary. Now, this is very interesting because I have friends who are actually doing this religiously and doing this very successfully. But the key here is you don't save this money at the end of the month. You save this money the first moment that you get your salary. Because trust me, if you don't do that when you get your salary, right, by the end of the month, nobody will have enough money.
Yeah.
Yeah.
Because So the point here is you must save first before you spend.
Save for yourself first. Yeah. Okay. So don't underestimate the small amount that you put aside every month. So based on 500 ringgit a month, you're looking at 60,000 a year. Now, if you multiply over 6 years, that's 36,000. So over here, our simple scenario, we're trying to illustrate. Now, I'm going to start with 20,000 capital. I'm going to save 6,000 on average every year, and my target is to grow that money, all right, to 100,000 in 6 years' time. Now, when you input these parameters in your TVM stands for time value of money calculator, right? And you click on the word, the button rate, right? You come to 15% per annum. Now, you may not agree with these numbers. You can actually tweak these figures in your app later when you do your exercise. All right. So just for this tonight's webinar, let's say that this is the typical person's aspiration when he wants to buy a car in 6 years' time, right? So if I start today with $20,000 ringgit, I save 500 every month, I invest properly. So the keyword is invest for 6 years. The required return is 15% per annum. Now, this is very important because most of us, when we invest or buy stocks in the stock market, we never have this plan. So if you do not have this, let me ask you, how do you know that you are not taking enough risk for you to achieve your goal? On the other end of the spectrum, you may be taking too much risk. For example, if your KGA is only 8%, why would you need to buy high risk stocks? All right, like oil and gas, isn't it? Yeah. So setting this very first step is very crucial.
So yeah, before you talk about this, we need to know what is the investment KGA target. Okay?
Yeah.
Because before we talk about investment, we must know what is the objective.
Correct.
Should we do it for children education, retirement fund? After that, we need to determine what is the KGA target that we aim for.
Yes. So you can do this exercise for different objectives as well. For example, if it's for your own retirement, then the number of years, the periods will not be 6. It could be 20, 30, 40 years, depending on your age. Okay. It's for your children's education. Depending on the age of your children, it could be 15 years, it could be 10 years, 12 years, so on and so forth. All right. But this is a very important exercise. Yeah. So now moving on, I will show you why this this KGA target is important, because it will impact your planning stage for your buying enterprise.
So that is the essence of today's webinar, the science of buying.
Yeah. So in this topic, we're going to talk from the beginning, from the planning part, all the way to the execution. Now, in order for us to plan properly, we need to know what is our KGA target. That is why I talk about the objectives, setting objectives properly, as well as getting your KGA target right. Now, so again, this slide is from our previous webinar, a recap. Now, you see from the top, your KGA target will determine your risk tolerance or risk appetite. Then, by extension, you will know what kind of stocks that you need to put in a portfolio. Okay.
Because if you have a very low required KGA target, we don't have to take so much risk.
You are right.
Go for safer kind of stocks.
So in our model, we actually follow the Peter Lynch 6 categories of stock. So basically, we categorize all the universe of stock into 6 groups: the stalwarts, the slow growth, and the fast growers. Basically, the right-hand side are the less risky one. The more risky one is on the left-hand side, the cyclical stocks, the asset plays, as well as turnarounds. Now, turnarounds, there's a reason why I put it red color. It is the most tricky, highest risk, and Peter Lynch says that most of the time, turnaround does not turn around. Okay, yeah. So, but of course, if you manage to get 1 or 2 turnaround right, the return is tremendous, leaps and bounds. Okay, now, so. This is I'm not going into detail because we talked a lot about this in the previous webinar already. Now, moving on, after we get our KGA target, we know how much we need to start investing today. The next step is how to set out your portfolio. Okay, and we talked about this also a little bit in the previous webinar. Now, the first step is having an allocation plan. All right, an allocation plan, in other words, in layman's term, is like a budget. All right. A budget plan on how you need to invest your capital, all right? The 100,000 capital in this example. Now, if you look at the table in front of you, basically this is a 100,000 ringgit portfolio allocation with spread over 6 stocks. Now, it doesn't mean that your allocation needs to be evenly distributed. All right, it can have different weightages. For example, if you look at this portfolio was the allocation plan was this planned on the 4th of January, so earlier at the beginning of this year. And the risk profile, the risk tolerance is actually moderate. And the target for this portfolio is 15% per annum, which means to double the 100,000 to become 200,000 in 5 years or less. Okay. Now, in this portfolio allocation, the biggest allocation is actually for AirAsia. All right, 25%, which is about 25,000. The second one would be UGTech, then followed by True Protect, Getronic, Elsoft, telecommunications, so on and so forth. Yeah. Now, the thing about allocation is that an allocation plan is not an execution plan. It doesn't mean that now I already know how much I need to put for stock A, B, or C. It doesn't mean that tomorrow when the stock market opens, boom, I buy everything. No. Again, like any project, all right, you have a budget, but doesn't mean that you have to spend the budget right away, isn't it? For those of you who are privy to what is a project management, this is actually very similar to that. Okay, we set aside this money for this particular group of stocks, but how and when we execute the purchasing is another act altogether. Yeah. Okay. So now the parameters to consider for your allocation plan is actually again number one, your number of stocks. For example, in this case, if you're 100,000 portfolio, you're not going to stretch your portfolio to 10 stocks, to 15 stocks, because if you do that, then the allocation may be too small. And if your allocation is too small, especially for stocks that are quite volatile, which you need to trade, may not be the ideal case. So as a rule of thumb, for anything less than 100,000, I wouldn't go more than 5 or 6 stocks. Yeah. Yeah. Now, if your portfolio is small, say 20, 30,000, then I wouldn't go more than 2 or 3 stocks, and that is where your stock picks is very important. Yeah. For 5 or 6 stocks, it's okay if 1 or 2 stocks does not perform over the short term, right? Because the other stocks should cover well. Now, secondly is actually the exposure to each stock. Okay, this is what we call the weightages. Okay, in this case, you can see that the highest weightage is on AirAsia, 25%. Normally, as a rule of thumb, we wouldn't recommend for exposure to be more than 30% for one stock, unless you have very good reasons. It's very simple, because no matter how well we do our studies or how we know business, there's always a chance or probability, right, that something may go wrong in this business. So imagine if you do not control your exposure well. Say you put half of your capital in a stock like AirAsia, and recently AirAsia came down to as low as about 240, 250, right? That's from this allocation is about 20% drop, 20-30% drop. So if you put 50% into this portfolio and it dropped 30%, that is 15% to your portfolio. Your portfolio will be down 15%. So can you stomach this kind of volatility? That's why we need to make sure that we do not expose too much in one stock. Now, on the other hand, all right, sometimes when we put too little allocation in the stock and the stock doubles up, it doesn't make much difference to our portfolio as well. So there must be a balancing, right? Then, as we talked about last time, sectors, stock categories, timing risk, so on and so forth are also key points that you need to consider when you do your allocation plan. Now, in this example, you can see that actually we are quite heavy on technology, because as a group, our core research is actually on technology. So you want to talk about Inari, Getronics, Elsoft, UGTech, right? We can talk inside out how the business is run, the business model, their clientele, and the risks, so on and so forth. Yeah. Okay. So these are the basic key things that we need to look at when it comes to constructing your portfolio as well as the allocation. Yeah. Now, next we move on to actually what are the buying strategies. Okay. So now you have an allocation plan. All right. Next is how do I buy? Right. Simple as that. So most of the time, people go to the stock market without a plan.
They hear tips.
And worst thing is when they see the stock price start to jump. For example, last week, AirAsia actually, when they announced this 90 cents special dividend, the next day what happened? The stock gap out, shoot to about $3 plus, right? And you buy because you see the stock price shoot up. That is what we call impulsive buying. And more often than not, impulsive buying never ends, never has a happy ending. Yeah. Okay. I think AHA has retreated then. So impulsive buying is not a strategy at all. It's purely based on emotions. Okay. So if not this, then what are the strategies that we should employ? Now, in this webinar, I'm going to talk about two very generic ones. So people know about. I think most of the people will know what is dollar cost averaging.
Every month.
Yeah, every month. So buy. So you can apply this here. Like when you have a specific set of price, you buy the same allocation. I'm going to show you. I'm going to share a bit details with a case study later. Yeah. Now, but dollar cost averaging is not intuitive. Okay, because by right, when a value asset or value company, when it goes cheaper, by right you should buy more, isn't it? Because it's so valuable. Now, so to mitigate this, there's another method called the value averaging. So I borrowed this term from this author called Michael E. Porter. All right, he has a book on value averaging, and I recommend all our viewers to actually buy this book. It's available in major bookstores. Okay, now moving on. Now, what I'm going to share is actually the buying strategy for passive portfolios, meaning for your retirement, for your children's education, not for short term. These are for long term, meaning 5 years and beyond.
Safer type.
Yes, and this is also more conducive for investors who do not have time, like I do, to actually follow the business day in day out, to track the stock price every week, things like that. So these are more for the portfolios that you just buy good companies, put it aside. Maybe you check every week or every month, that kind of enterprise. Yeah. Okay. Now for this, we have in-house. We develop a system called the M.A.S. M.A.S, which stands for marker. So there's a typo there. It's not market. It's actually marker. A for automation. S for security. Okay. So the M.A.S strategy is quite a pragmatic and simple method that do not need us to be laser sharp in our timing. I'm going to explain why this is the case later. Now, the key principle for this strategy is to enable us to track what is our average balance cost for the stocks that we invest in. Now, the idea is very simple. I want my average balance cost, or the ABC, to be as close to the market price as possible, isn't it? So that when the price of the stock jumps out straight away, I'm in the money already. Agree? Now, most of the people, they plow all their allocation at one price, say $1. When the stock price dropped to 80 cents, that's 20% downside loss already. Okay, so our objective here is to track that ABC as close as possible to the market price, so that it takes shorter time for us to be in the money when the stock price rebounds. Yeah. Now, so this strategy is not aimed to maximize your return. No. The key principle here is to minimize our downside risk. Okay, and this strategy, and I cannot stress this enough, this strategy must only be used for fundamentally solid stocks. So please don't use this strategy for your speculative stocks, for your trading stocks. It will not work, and if you get the wrong shares, right, you'll be digging your hole deeper. Trust me, I've done that. All right, it's definitely not for this kind of categories of stock. Yeah, so I repeat, the M.A.S strategy that I'm going to talk about later is purely for passive portfolios as well as for fundamentally solid stocks. Now, if you ask us, so David, how do we characterize what is a fundamentally good stocks? Please go back to our previous two seminars, webinars. I think that was the first webinar last year. I talked about the criteria for us to select stocks for value investing. Yeah. Now, so without going too much into the words, I normally like to visualize our concepts. Okay, this is how we visualize the M.A.S strategy, right? So it's basically like a pyramid or a triangle, with the tip, the smaller portion on the top, the marker, the yellow color. Now, the yellow color is a small part of the whole pyramid. The biggest portion is actually automation. All right, and last but not least is the bottom layer, which is we call it the security or the buffer. Yeah. Now, if I put more details into this, it's very simple. Now, horizontally, the triangle gets bigger at the base, isn't it?
Yes.
So it means that as the price comes down, actually we should be buying more shares in this strategy. All right, the value averaging strategy. Now, as the price come down, as the share price decrease, it means that we need to spend more allocation. All right, the allocations of we start with a small allocation first, maybe 1,000 at the top is the marker. Then as we come down, it should be maybe 1,500, 2,000, 2,500. Now, at the end, if you sum up all your trades, it should make out your total allocation for that particular stock. Now, as the price comes down, actually the timing is more important, especially for the third layer, which is the security buffer. All right, where but sometimes because the market is too bearish, too many bad news like what is happening lately with the US-China trade war, right? We may not want to spend our allocation for that layer right away. We may want to scale back, all right, because we never know how long it's going to drop further. All right, I learned this lesson because last time I do not have this. I only have the market automation. That was our age, the time when I started to invest in Asia. I finished all my allocation at 160, which is coincidentally the net tangible assets per share for the Asia. Then what happened after in the next 2 months? Asia dropped to 80 cents. Yeah, so that's another 50% drop. So we learned our lesson. That's why we come up with this additional security layer for us to limit our downside risk.
Okay.
Yeah. Okay, so in a way, what we're trying to say is actually these strategies are not theoretical. They are actually very pragmatic and very practical.
Okay, so may I sum up is that let's say now Air Asia is 280,
Yep.
288, all right? So maybe you can use marker to
Yep.
buy 1,000.
Or depends
Let's
on
say
your
1,000,
allocation. Yeah.
Let's say buy 1,000. So Air Asia dropped to 270.
Yeah.
You put in to buy 1,005.
Yes,
then
correct.
drop a bit.
Yeah.
You buy 2,000.
You're absolutely right.
Buy 2,005.
Yeah.
So that is still in automation, right?
Yeah.
So probably when it dropped to, let's say Air Asia, it dropped to 2 ringgit.
Yeah.
Maybe it's
You never know because
go.
CIMB gave Asia a price tag of 150.
Yeah. So let's say it dropped to 2 ringgit. This is where security and buffer comes in.
Yeah, it kicks
so
in.
when you buy more,
Mm.
when you buy more share.
Yeah,
Okay.
so there's a reason why it is a triangle or the quantity of shares is larger at the base. I'll explain it later.
So let's say that we have 20,000.
Mm-hmm.
How much should we allocate for market? How much should we allocate for automation? How much should we allocate for security and buffer?
So great question. So actually the following on, we're going to talk about how we actually deploy our allocation, the execution part, right?
Okay, cool. I'm a bit early.
No, I think you're just in time, yeah?
Okay.
So now, so as mentioned by Shane, right? So no worries. Let's talk about what is the meaning of marker first.
Okay.
Now, a marker, as the name suggests, is where we mark the stock. Now, trust me, if you do not have the stock, when you have not put in a single stamp for your stock in a portfolio, right, you won't be interested in it. But once you have your first purchase, then suddenly, wait, I'm an investor now. All right, I better make sure that I follow what's happening in the stock. This is what we call the marker. Now, the marker should only be a fraction of your allocation. So, for example, just now you talk about 20,000 allocation, right? So, when you talk about fraction, there's no hard science to it. It can be 1,000 ringgit, it can be 2,000 ringgit. But try not to put 5,000 ringgit. Why? Because 5,000 over 20,000, that's 25%. So that's a huge chunk already. We try to limit our marker not more than 5% of our not more than 5% of our allocation. Yeah. Sorry, not more than 10% of our allocation. Yeah. So 20,000, I wouldn't go more than 2,000 for the first buy. Okay. The marker reduces the impact of the timing of the first entry. It means that, for example, in your case, in your example of Asia, so let's say tomorrow when the market opens, I have a plan to buy to mark Asia at the market price. So whether it opens at 288, 290, 287, doesn't matter to me because I'm only spending a little bit of my allocation. All right, I'll explain in figures later why this is so. Okay, now the size of the market, as I mentioned, should not be too large to avoid top-heavy situations. You don't want to get into that where you may overrun your budget if the price falls too drastically. Yeah. And on the other hand, the market should not be too little as well, because sometimes when you're lucky, after you executed your first buy, what happens to the stock? It shoots up. All right,
Yeah.
then you say, I should have
Bought
bought some more,
more,
right? Yeah. So there is a balancing act here. It shouldn't be too much, it shouldn't be too little, but at the end of the day, it depends on your risk appetite.
So from your example just now,
Mm.
you were suggesting that no more than 10%.
10, 15%.
10, 15%,
Again, there's no
huh?
hard science depending
Okay.
on, yeah.
Yeah.
Because you see, when we have this, if the price goes up, I'm not sad. I'm still making money. I'm making less money. If the price does come down, which we hope, then we say, good, we anticipated this and now we can deploy our capital.
Alright. So for the case of a smaller capital, such as 10,000, 20,000, per se 20,000. So if we spend 2,000 on one stock,
Mhm.
and then much of a bigger percentage of the money will go to the brokerage fee and the transaction cost, right?
True.
Because you're buying in so small the
Mm.
quantity, because you segregate to so little
Yep.
for the market.
Yep.
Will it still be
Well-
worth it?
Well, there is another way to look at this. Don't miss the forest for the trees.
Okay.
Yeah. So sometimes the way we look at it is we rather pay this extra overhead to discipline ourselves.
Mhm.
Okay. I would rather spread my purchases over a few trades rather than go for one. Or although if I spread over a few trades, the overheads are high because I pay more brokerage, right? But it's a way to discipline myself to take the emotion away, because you never know what will happen in the stock market tomorrow or the next week or the next month, regardless of how fundamentally good your business is. Okay, so it is in a way we purposely pay those overheads to discipline ourselves in our trades. Okay, now let me give you an example. As you mentioned just now, so here we talk about 25,000, our A-Asia allocation just now, right? Suppose you have the 100,000 portfolio just now and you have allocated 25% for the stock A-Asia. For this hypothetical stock that closed at $1 the day before, meaning today, let's say it closed $1. Tomorrow, I intend to buy 5,000 shares. Okay, now in this case, tomorrow when it opens, okay, my plan is to buy at ringgit. 5,000 shares, so which I will be spending $5,000 or 20% of allocation, right? Now, then you have to understand that for every 1% variation on the stock price, right, the difference is only $50. Okay, now is $50 a lot? Let's look at it from a context. In context, $50 over your allocation of 25,000. That's not even 1%. That's 0.05% difference of your entire portfolio value. All right. So whether when the market opens, you buy at $1, 101, 102, 99 cents, 98 cents, doesn't make too much difference. Because remember, your first allocation is always a fraction of your total allocation only. Yeah. So I hope that this is the reason why timing is not so important or not so crucial in our first buy. Okay. Now, next comes to the automation part, right? Now, automation, there's the reason why we call this automation, because by right, this step should be fully automated as much as possible, meaning you don't have to watch the stock market for you to execute this part. In fact, we have a strategy, we have a system to help you automate, but it depends on your broker, yeah? Now, after the market is bought, what follows is the automated trading part system for your subsequent buying of the stock. Now, bear in mind that this is only doable, okay, if you have an online trading account. It's very important. This does not work if you need to call your reminder to buy your stock. This is purely for internet trading. If you have internet trading, and not just internet trading, you need to have this feature called Good Till Date, GTD in short. Okay. These days, most online brokers will have this feature. If you do not have, please call out your dealer or your broker to request for this feature. It should come to you for free. Now, depending on your broker, most brokers will give you 30 days. Some brokers may give you less, say 15. Some brokers may give you longer. Now, what this means is this. For example, if I park a trade to buy 5,000 shares at $1, but today it doesn't match for whatever reason. Maybe the stock price went to 105. So, but most of us have a day job, right? We can't afford to glue our eyes to the trading screen every 24/7, right? So this system, the GTD, will actually help you to queue the same order into the system the next day. If it doesn't match the next day, it will continue to do so the following day for as long as 30 days or until the trade is matched. Now, for example, let's say on day number 5, suddenly the market tanked for whatever reason, your 5,000 buy order was hit. All right, at the end of the day, your broker should send you an email to inform you, hey, today your order has been matched, and this is your contract. Okay, now what this does, there are two things here. One, I don't have to watch the stock market every day.
Which is very important.
Very important, yeah.
Save us our time.
Correct, and it doesn't. We don't need. We do not. We are not handicapped by the market, right? And secondly, and which is this very important, it takes out the emotion from our trades. Now, trust me, if you say you want to buy $1 and you see the share price went up 5%, most people will do chase impulsive buying, or when you want to buy $1, then the next day you see the share price drop 95 cents. What would you do? Hey, maybe it may drop to 90 cents. These are all emotion driven. Now we want to minimize our emotional elements as much as possible when it comes to trade. The best way is to trade like a robot, no emotion at all, whether it's buying or selling. Yeah. So this is the feature that we employ. It's a free feature anyway for us to take out the emotions. Yeah. Now, so what are the key parameters that we need to take care of when we do the automation part? Now, number one is the price range. It's very important. Now, just now after our market at $1, so what is the next buy? We have to determine that. Now, in order to do that, you need to understand the stock. When I say understand the stock means you have to understand the business behind the stock. Now, is this a volatile business? Like your Asia, very volatile, or is it the very more steady business like Nestle? All right. Now, because this will affect your this parameter for the price range. For example, Asia is very volatile, so you don't want to have a very tight range, because if you have your range is too tight, you may just finish your allocation in no time. I give you an example. If you know that historically in the past year, Asia can fluctuate 10% every month, which is actually information that they publish in the annual report, then you may want to have a price range which is more than 10%. Now, for example, if you have a more less volatile stock, you may want to have a tighter price range to capture the volatility. Yeah, and actually the second one is actually more important, which is number of steps to be executed. Now, depending on the allocation for automation, you don't want to have too many steps. You don't want to have too little steps as well. So for a normal allocation, say 25,000 to 50,000, even 100,000, right? I wouldn't recommend more than 5 steps for this automation. Okay. I'll explain a bit more later with a case study. Now, the number of steps do not have any much implication to your ultimate ABC, your average balance cost in this strategy. But the last price in your price range will have a much higher impact. And why is that? It's very simple. Now, if you go back to the visualization of this strategy, right? Bulk of the money is spent not on the top, but at the bottom of your strategy, right? So it means that most of my money will be used when the price comes down. Okay, that is why the last price for our last trade, right, is very important. Okay, if our last trade is too high, then our average balance cost of ABC will be too high as well. Okay, and vice versa. Now, we were going to illustrate two types of buying strategies with this M.A.S. Okay, basically it's a strategy similar to DCA, our dollar cost averaging. We call it equally distributed. The next one is value averaging. Yeah. Now, so again, we follow from our previous example. Okay. So say I think there's a typo here. Say after spending our marker, we have about 15,000. 15,000 earmarked for automation stage. So this is excluding the buffer, yeah? And it is intended to be equally distributed over 3 price steps between 90 cents to 70 cents. Okay, now let's illustrate what I'm talking about here. Okay, now visually, if you look on the left-hand side, after we spend the market at $1, what follows that is the automation, the green boxes, yeah? So we're gonna, in this scenario, we're gonna split the 15,000 to equal blocks of 5,000 ringgit. Okay, we're gonna buy 5,000 ringgit worth of the same shares at 90 cents. Then we're going to buy, the next price will be 80 cents. We're going to buy 5,000 ringgit. And last but not least, the 70 cents and 5,000 ringgit. So this is where the good till date, your GTD, comes into play. So what's going to happen is after I buy by marker, I'm going to key in my broker, right? Say, okay, I'm going to buy 5,000 ringgit worth of shares at 90 cents, which translates to 5,500 shares. So if you take 5,000 ringgit divide by 90 cents, you should arrive at 5,500 shares, roughly there, approximately, right? So I'm going to key in the trading broker screen, buy 5,500 shares at 90 cents, good for the next 30 days. Okay, next, I'm going to key in another order, buy 6,200 shares at 80 cents, good for 30 days. And last but not least, buy 7,100 shares at 70 cents, good for 30 days. Then I'm going to just let the system do its work. I'm not going to watch the stock market. And every time there's a hit, the broker will send me an email. Okay. Now, what happens if you manage to do this, or this plan managed to be executed over I don't know how long? We would have spent a gross 20,000. Remember, the marker and as well as the 3 automation blocks, we will have spent 20,000 to buy a total 23,800 shares. So if I take 5,000 shares plus the 5,500 plus the 6,200 plus the 7,100, on total it should be 20,800 shares, including the market position. Yeah, and this translates to an average balance cost of 84 cents. Now, if you don't know how to calculate average balance cost, no worries. Go back to our previous seminar in December 2018. The formula is there. Yeah. Now, this 84 cents is still 14 cents above our first price, isn't it? Sorry. 14 cents above the current price of 70 cents, which means that actually our cost is still higher. But imagine if the stock price, the current price 70 cents, it went back out to 84 cents. We basically break even already. We don't have to wait for the stock price to go back to $1 for us to break even. In fact, when the stock price U-turn to $1, we will be making money already in this strategy. And by the way, up to this point, we haven't even spent the security layer. All right, security layer is like our petty cash for rainy days. Okay, so in this strategy, we talk about M&A first. Okay, now, but you look at this and say, David, this is again equally distributed. It's not so intuitive. Why don't I buy less at the top, then more as the price comes down? Because I want to reduce, or I want to minimize my ABC as much as possible, as close as possible to the last buy price. That's logical, isn't it? So how to do that? We go next to the other method, which is the value averaging method. Okay. Now basically what this does is, now again on the same price range between 70 cents to 90 cents. Now instead of buying 5,000, spending 5,000 ringgit at 90 cents, now we're going to spend 2,500 first at 90 cents, meaning we only buy 2,700 shares. So the same thing, you key into the GTD, right? Buy 2,700 shares at 90 cents. The next would be 6,200 shares at 80 cents and 10,700 shares at 70 cents. Now, by doing this, the shape of your strategy is different already. So instead of a straight ladder, now it's like a pyramid. But of course, the first step is slightly bigger. Okay, now when you do this, remember, recap from the previous example. In this, we would have accumulated 23,800 shares with an average balance cost of 84 cents. But in this scenario, what will happen is, if we manage to buy all the shares to from A1 to A3, the same 20,000 ringgit that we spent would have accumulated 24,600 shares compared to the previous case. Now, and instead of 84 cents of ABC, now it's 81 cents, which is only about 15% above the current market price. Meaning, instead of waiting for 84 cents, now if the share price goes back up to 81 cents, we would have break even already. Okay. Now, why is this important? Without this strategy, most of us, what happens is, the market opens $1, we buy everything, right? In Chinese, we call sai lang. Yeah. Okay. Now, what happens when you do that is, let's say, imagine you spend your entire allocation of 25,000 to buy the stock at $1. Now, what will happen at 70 cents is you would have a losing position, a paper loss of 30%, instead of, say 15% in this case. So what's going to happen is, I lost 30%, cut loss.
Mm.
Yeah, but what you may know is actually if you cut it loss at that price, there's a lot of value if this is a good business. Yeah, so this is the reason why we want to employ this kind of strategy instead of buying one shot. Okay. Again, like I mentioned just now, suppose the market normalizes, things get back to normal and the share price goes back up to $1. Now, this particular strategy for value averaging would have given you a very handsome profit of 19 cents per share. And because your average balance cost is 81 cents, you earn 19 cents, that's 23% profit instead of just breaking even at $1. And that is the beauty of this strategy. Yeah. Yeah.
Okay. So what you were just sharing with us is a very logical way or methodological way
Yes.
to arrange our
Buying.
capital allocations.
Yes.
As well as the how much to allocate for each price.
Correct.
All right.
Correct.
So, but let's say if after we buy at RM1 and it straight away go up,
Yep.
what do you do?
So the problem is, it go up. How sure are we that it's going to come down? Right? So that's something that we're always concerned about, right? Now, let's hypothetically speaking, say the price went up to 150, 50%, right? And chances are very low that it's going to come down to 90 cents.
Yeah.
So suddenly, gosh, I've got 25,000 ringgit allocated. I only spent 5,000. I've got 20,000. What are these? Money, right? Now, suppose that now, okay, I'm fine with this stock A. I've got 20,000. Now, can I use this 20,000 to sell another allocation for another stock?
I mean, you move on.
You move on,
Okay,
all right?
Don't chase that. Huh?
Well, there is an advanced strategy where you can actually modify the strategy with a different shape, but that is not what I want to share tonight.
Okay.
Tonight is beginner.
Alright.
Yeah, beginner. Of course, there are more advanced steps moving forward.
Okay.
Yeah. So again, because don't forget, if you do this right, in your portfolio you may have 5 or 6 stocks. Now don't forget that each of these stock will have its own cash portion. Yeah. Okay.
So why don't we talk about the security level?
Yes. So moving on, the security buffer, if you do it right, most of the time you may not even need to touch this. This again is like what we call our rainy days, our petty cash, right? It is very crucial stock allocations, which sometimes is untouchable, like I mentioned. Now you see the problem is no matter how well we know the business, even though we know the management, right, chances are you never know what happened to the stock market tomorrow. Donald Trump may be going on a tweeting spree over the weekend that crashed the stock market. That's like what happened recently, right? Many times already. So this is like a worst case scenario. In case things do turn ugly, do we have some extra cash to catch more shares at the bottom? Yeah. Okay. This is where the security buffer comes into play. So in such a situation, the final sub allocation provides a buffer. Okay, in case we need more bullets, all right, to bring down our ABC of our holding shares. Yeah. Again, in this part, the timing plays a more important role, and it will be more sensible for the investor to actually employ some sort of timing strategies to before we actually execute the buying for this layer. Now, again, there is no exact science on how this allocation how much should be allocated for this layer, or how we can actually execute the buy for this layer. All right. But this is a more advanced topic. I'm not going to talk about it tonight. We're going to focus only on the A, M, and the A. Okay.
All right.
Now let's look at one example that we've done before.
Yeah,
right.
a case study will be very helpful.
Yeah, case study. So this is what we have done for AirAsia a couple of years ago. Again, like I always tell you, Shane, right? Every time I buy a stock, what happens the next day? Crash, share price comes down, right? Exactly what happened when I first started buying AirAsia in 2015. This is a real trade. I bought AirAsia at about 230 plus, 230, 240. What happened the next 4 months? The price crashed from 230 all the way down to 80 cents. Okay, now imagine if I use all my money to buy at 230 and when it comes 80 cents, gosh, my portfolio will be very red, right? So because we employ the ABC, so it gives a very different picture. Now, this is the final outcome. The blue line is the share price, and the red horizontal lines is actually our ABC. So we track our ABC very closely. Now, I want to highlight here, give it an end in mind. Look at the arrows. There are 2 arrows, yellow arrows. these are the arrows where the ABC is close to zero. Would you like that?
Sure.
Your cost is zero, but you're still holding the shares. Amazing, right? It's like you buy a property, and after some years, your cost of holding the property is zero. You're holding it for free. Now, how is this possible? It's very simple. I'm sorry for the very small fonts. I just realized when Shane told me, but basically I color code it. Now, look at the top part with the yellow part. So this is where we deploy the marker. Now, in this scenario, I actually allocated 40,000 in this portfolio to buy Asia at that time. Now, of course, that time I wasn't so experienced yet. So I did a mistake. I went quite heavy on the top. Remember? Now, I spent close to 14,000 of 40,000. All right, this is more than 20%. Okay, as my first buy. I think it's actually more than 30%. Okay. Now what happens after that for the next few lines is actually just trading action. But you see when it starts to focus on the green parts. Now so my first buy was about 2 ringgit 30 cents on April the 3rd 2015. I bought 6,000 shares. Now if you zoom past to the green ones, in by 21st of May 2015, which is about slightly more than 1 month later, the share price came down to 2 ringgit 17 cents. I bought 2,600 shares. Now, then subsequently, I bought 3,500 shares at 210 and 7,500 shares at 190. Now, although there is not exact difference for each price, but basically the shape should be like a pyramid, okay, but with a very heavy top. Okay. Now, what happened then after 210? 190, I finished all my allocation of 40,000. And what happened to the share price? Boom. Okay, so what happened that time was I had to find I had to scrape for more capital from other allocations. Say, oh, this stock, other stock, top glove, but then you make money already. I sell the stocks, get that capital, extend the pyramid. Okay, so this is exactly what we did. Okay, so subsequently, for the buffer, all right, we actually plow in more money. The reason again I said is we try to have our ABC as close as possible to the market price. Now again, I want to highlight our mistakes. All right, in this trade. Number one, we were too top heavy when we buy our first marker. Now, secondly, when we do the price range, remember one of the criteria is the price range. The last buying price, I priced it above the NTA per share. I thought, hey, come on, Asia trading at NTA, it means that I'm only buying the metals. I'm only buying the scrap metal. Not Asia.com is free. All right, the routes are free. Okay, and at that time we thought it's never gonna happen. But trust me, when you're so confident in your analysis, right, that is when the market will prove you wrong. Okay, so what happens is what do we do? We actually double down on our research into Asia. We track back. Okay, is it really? So what happened there was there's an accounting firm from Hong Kong that accuses Asia of fraudulent accounting. And they'll say they're milking the associates, business is bad. So in fact, I fly Asia a lot. I fly back to my hometown in Kuching. I fly to Penang for AGMs. I fly to Johor to meet my friends and clients. I say, hey, every flight is full. Asia business is booming. And secondly, we look at the accounts. As I mentioned, as I shared in my previous webinars, we focus not just the P&L, but we focus a lot on the cash flow. The cash flow for operating activities is fantastic. In fact, AirAsia was having a cash flow of more than 1 billion ringgit. If I were Tony Fernandez, I would be laughing all the way to the bank. So this gave us the conviction that what we're investing is good business. All right, we push away all the noise. We look through beyond the smoke screen, and that is where we bought back. We bought a lot of shares. We continue to buy. Okay.
Were you panicked that time?
If I tell you that I'm not panicking, I'll be lying through my teeth. Right? Of course, I worry a lot.
So study a bit more.
Of course, that is where we actually spend more time to study the business. That is why today, I can sit down with you for half a day to talk about Asia business inside out. Yeah. Okay. So what happened was. So I go back to this chart. Now you see what happens after the bottom, the share price does bounce back up. Now, in fact, when we did this strategy, we gave ourselves 3 years for the share price to recover. But we were quite lucky in the sense that actually the share price rebounded much shorter than that. Now, at the end of that year or the year after, right, you see what happened was the AHS share price went from the low of 80 cents all the way to above 3 ringgit. Now, okay, now here is coming to the selling part. Okay, you see, to maybe from 80 cents to 150, that's double out. 80 cents to 150 is almost 100%. Should you sell? All right.
Should we sell?
Should you sell? I don't know. But because don't forget, 150 is still below the NTA of 160. You see, as you can see from here, we were not selling too much. In fact, we were holding on to our shares. We were selling a lot somewhere when the red line dips down. Okay, now why? When we sell on the right direction, your average balance cost will come down. Okay, we are basically reducing our costs. Okay, all right. Now, we trade a lot along the way. So if you look at the total campaign, our total buy, if we sum out together, is about 33,000. The total sell is about 250,000. And in that period, we've accumulated about 4,500 of dividends. So very obvious that the cost of holding the remaining shares are basically free because the money that we get back from the selling as well as the dividends are more than the money that we spend to buy. Okay? Now, so this is where I want to talk a little bit. I'm going to move, carry on to a bit more to talk about the art of selling. As I mentioned just now, right? Whether you want to start selling at $150, $2, $3, or even beyond that, is a very personal decision. Yeah. Okay. Now, while there is a specific method to buy shares, that we believe that the selling part is more of an art. Okay, and the approach is more of an art than a scientific approach for the following reasons. Very simple. Number one, your risk appetite and your friend's appetite or my appetite is different because we have different KR targets. And we may have different understanding of the business. I know Asia business inside out. You may not know so much, or you may know more than me. You may know more, maybe bad stories or about the management, which I don't know. So each of us has a different angle looking at the business, right? So there are a few tools that you can use for your exit strategies. You can use fundamental timing risk. This is something that we're going to talk about in the next webinar, your portfolio timing. Okay, then you can employ some charting or technical analysis up to your preference. Yeah. So again, as I mentioned just now, when you sell the right direction, meaning you sell at the price higher than your buying price, it straight away reduces your average balance cost of the share. Okay, and this is something that we talk about in detail in the previous webinar. Yeah. So what are the reasons of selling? Very simple. Your stock price has reached your price target and you got to be disciplined. You got to start selling. You cannot say, oh, because the share price is so strong now, I wait for a bit. Now, when it comes to selling, you don't have to sell everything in one go again. All right, you can sell a little bit by bit. Okay, because you can never sell the share price at the top. Much like the same thing, you can never buy the share price at the bottom. No such thing over the long term. Yeah. Or the position has met your KGA profile target, which I'm going to share a bit later, is to reduce exposure of a stock because sometimes when the share price comes out, right, it actually increases your exposure of the stock, and it can be for the purpose of rebalancing. All right, and most importantly now, when the business fundamentals have changed, especially if it has turned to the worst, it is time to sell, regardless. Yeah. Well, of course, if the price is lower, then your average is cut loss. If it's higher, then it's taking profit. Yeah. Okay. Now, so in the case of AAsia, right? If you are a student in our course, we feature AAsia in detail. We actually talk a lot about AAsia in our 2-day course. Now, again, just say that you believe me that we value AirAsia, this airline, at $6 over the long term. And we started doing this in 2016. Okay? All right. That is why if you go to our Facebook, we have a very big banner, red color, say AirAsia, see you at 20 billion. 20 billion is the market cap, which translates to a share price of $6 based on the number of shares today. Okay? Now, suppose in June in 2016, the share price is trading at 240, but my target is $6. So my question is, Do I hold on until $6 before I sell? All right. Knowing that I bought AirAsia from 230 all the way down to 80 cents. Okay, so the big question here now, the $1,000,000 question now is, how do I wait until $6 before I sell? Now, there are a few ways for us to help us make a more informed decision. Okay, I'm going to show it in a visual form. Now, at that point in time, in June 2016, all right, our position for AirAsia in this portfolio, so our quantity, our balance quantity is 20,000 shares. Our cost is 150, all right, 1 ringgit 50 cents per share. The market price now is 240, okay, which means that if I multiply the 240 with 20,000 shares, this is 48,000 on my portfolio, okay, and the portfolio value at that point in time is 136,000. If I take 48,000 divide by 136,000, that the weightage, the exposure is 35%. Now remember earlier on I say the rule of thumb, my rule of thumb is not to have more than 30% exposure in one single stock. This is what I call concentration risk. Okay. Now, suppose the AirAsia profit at that point in time is actually 18,000 or 60% of my first buy price. Right now, look at this. What we decide to do, instead of waiting at $6, we say, hey guys, we can start to take trading action already. We can start to take profit off the table. Now, it's never wrong to take profit off the table when you are making money, because you will never know what is going to happen after that. The stock price may go up further, or it may just suddenly come down. All right. So we decided at 250 to sell. Remember, we had 20,000 shares. We decided to sell about 1/3 of the shares, 8,000 shares at 250. So our value of our trade is 20,000. So remember, I have sold 20,000 ringgit, which the balance quantity is 12,000, because 20,000 multiplied, take away 8,000 shares, I've got 12,000 shares left. Now, because I sold at a higher price than my buy price, right, my resultant average balance cost has straight away reduced drastically from 150 to 83 cents. Now, instead of having an exposure of 35%, which is very heavy, now my AirAsia weightage is only 7%. A much more safer, exposure that I can just leave it there for the time being. Okay. Now, basically, what this happened now is my margin of safety is 68%. Now, what this means is very simple. At 250, my cost is 80 cents. I don't care what the market does tomorrow. The share price may drop to $2. Do I lose money? No. I still make money. The share price may drop to 150. Do I lose money? No, because my cost is 80 cents. Now, at that point in time, suppose the share price does drop to 150, right? And assuming this is still a good business, can I buy back the shares?
Sure.
Sure, right? And this is the beauty of this strategy. It allows you to trade, and it takes away the emotion, because we are being very objective about it.
But if you buy at 150, then your average balance cost will go up.
Will go up, but it will still be depending. Okay, for example, at 150, you don't buy say 50,000 shares. They will straight away drive your average balance cost out. So there are some mathematics behind this. All right, this is more very advanced already. Yeah. Okay. So again, there's another angle to look at this is instead of a stock position, we look at it on a total portfolio basis, right? Now, again, I come back to the scenario just now where we at this 250, right? My profit in dollars term is 18,000 ringgit. Now, don't forget, let's take a few steps back. What is my objective when I started this portfolio 100,000? Is to double, isn't it? Meaning I want to grow from 100,000 to become 200,000. So my absolute target is actually 100,000 ringgit. Now, from this stock alone, I've already earned a profit of 18,000, which is around slightly less than 20% of my target of 100,000, right? Now, in this case, is it logical for us to take some profits already? Yeah, okay. Now, in this case, again, as I illustrated here, right? Because 80,000 is actually close to 20%, one fifth of my total intended 100,000 profit over 5 years. So I take the decision to take some profit now at that point, even though there may be a chance that the share price may move up. In fact, AirAsia share price did move up to $4. after we sell.
So what do you feel?
I feel sayang lah, but you see, that's why the M.A.S strategy, the key is not to maximize return, but to reduce our risk, to minimize our risk, as I have shared earlier on. Okay. Now the best thing here is, can I repeat this strategy for other stocks,
Well,
other good stocks? Definitely, right? Now, if you do it well, this is the 100,000. It was a real portfolio which started in 2015. Now, you look at Asia. What is the ABC? Zero. 5,000 shares left, which represents 7.7% of my exposure to my portfolio. Look at Getronic, 4,000 shares at zero cost, at close to $2, 1 ringgit 95 cents. That represents 4% of my portfolio. UG Tech, 5,000 shares, zero cost, using exactly the same method. But of course, this includes the dividends that we receive. Okay, at 290, that represents 7.7%. Now, my objective as a portfolio owner is I want to have more and more free shares like this. Does it sound good?
Sure.
Yeah.
Everybody wants free shares. Right?
Yeah, then you can let the management grow the business for you over time. Yeah. Okay. So this is the kind of we systemize this strategy and employ across all the stocks in our portfolio, and this is how we're trying to aim. Now, for your information, this portfolio was actually the case study portfolio from my previous webinars, and this portfolio has actually doubled up in 5 years' time. Okay, so again, if I wrap things up right, again, so like I mentioned, this is the portfolio that doubled up. So this was it doubled up in 2017. Okay, so let's look at it from objectively from 3 angles. Now, portfolio management, again, the after you buy and sell, right, it's important for us to track our performance with respect to our CAGR target. That is why in this chart, I highlight the 15% CAGR target. Now, that line is where your portfolio is supposed to be performing, assuming you are on track. Okay. Now, if you look at area A, the portfolio value, which is the blue line, is way below my red line, right? Which means what? My portfolio performance is below my CAGR target. So this gives me an alert, say, hey, I maybe need to reassess my strategy. I may have done something wrong, or the stocks that I invest in may be something wrong in the business. So I may need to relook in the business and see, do I need to make some change? So you can rebalance, you can maybe change, switch shares, all right, or I can actually rebalance some allocation from other stocks. All right, so that is what happened to me in this portfolio at that point, at that juncture. So I was rebalancing from other allocation. I think it's not here, but we actually sold off Padini, we sold off Top Glove, and used the money to buy more Asia at that point in time. Okay, now on the other hand, if you arrive at a situation like B, the green color, which means your portfolio performance is much higher than your intended target. Now, at that point in time, logically, as a value investor, what should we be doing? Should we be buying more, or should we be selling and conserving more cash? Now, of course, the logical thing to do is, because we're ahead of our target, is to actually reduce our exposure. So instead of having 35% exposure in Asia, we should sell our shares to reduce our exposure now, keep more cash, so that if the share price does come down, we can actually buy more. All right. Then at point C is where we actually hit our target already, long-term target. We double our portfolio. Then what should we do? We should reset our portfolio. Meaning we should just continue the same thing, reset the cycle. All right. If you want, I would normally recommend my friends to take some profits, go for holidays, buy your favorite phones, or give your honey or your wife a good gift, right? Then for the rest of it, reinvest back, right, and let your money grow. Okay. So basically, this is the essence of buying and selling, the trading strategy, right? So I've come to the end of my presentation. Now, if you're interested, we don't just talk about our strategies. In fact, we publish some portfolios, the real portfolios, on our Facebook. If you go to our Facebook, fb.me/fixpressmy, we have actually an announcement post. We have 3 model portfolios which we publish to the public, but the $1 million portfolio is only for our members, for our students. The 100,000 and 300,000 model portfolio is free to review, and you can see what is the strategies and trading actions that we employ, okay, to help to grow our wealth over the long term. Okay, so Chun Xian, Shane, this concludes the end of my presentation of my webinar tonight. So I think I'm slightly running ahead, overshoot the time.
A little bit, but it's alright.
Yeah.
I think you did a very excellent mathematic.
Yeah, you coming from an engineer, you can expect that we approach this in a very scientific way. But I'm sure this gives our viewers a very fresh perspective. They actually maybe some of them may not realize actually there is a specific step that they can use to actually buy shares. Yeah.
All right. So now, if you have any questions, please write in the question box, and we will do our best to ask your questions because there are just so many people. So please write your question in full sentence so that we can understand. Now, the first question I have on my screen is how do you determine whether the stock is moderate growth, high growth, or turn around?
Okay, this is a question from Chi Hong, right? Okay, Chi Hong, good question. Now, unfortunately, this topic is not covered in this because here is we talk more about the buying and selling, right? But if you flash back to our previous webinar, I'm not sure whether it was the first or second webinar last year. I do have information there, so you can look at it. Alternatively, you can always go to the bookstore and buy the book by Peter Lynch, One Up on Wall Street. Yeah. So Peter Lynch, he actually explained in detail how he categorized the stocks into stalwarts, high growth, moderate growth, and other categories. So I hope that I answer your question. Okay, Chi Hong.
So the next question I have is, what is your opinion on how long we should put for the good till date? Is 14 days good enough, or you choose 30 days?
Okay. I think this is a great question because it shows me that you are actually thinking about employing this strategy. Yeah. So as a general, this question is from Eric. Am I correct? Just now the question, yeah, for Eric, right? So okay, never mind. So normally, it depends on how much time you have. So if you're the kind of investor who really likes to watch the stock market, right, maybe 14 days is good enough. But as a general rule of thumb, I would normally go for 30 days. And actually, it's not a hard rule. Now, for myself, I actually employ a very specific strategy to monitor my GTDs. Okay, so you have to understand, I've got a lot of portfolios to take care of. In fact, I've got more than 40 portfolios. So each portfolio we have.
That is crazy.
So each portfolio we have on average 5 to 10 stocks, and each stock will have their own GTDs. So normally what I do is I specifically time the GTD to expire on the last Friday of the month. Friday. Why Friday? So that I can have Saturday and Sunday to review to the stocks as well as the trades. Yeah. So again, I circle back. It depends on your availability as well as how much time you have to monitor your trades. So normally, what I'll do is I specifically time the expiry date, or it could be 22 days, it can be 25 days, or 30 days at the last Friday of the month. Okay. So I hope I answered your question, Eric.
All right. Now the next question is stock specific.
Mhm.
Will AirAsia still have value after dividend payment of 90 cents?
Mhm.
Can we still buy, or is a sell signal now? So yeah, of course, as I mentioned earlier, we are not giving any buy or sell signal,
Yeah.
but you can
Well,
give it for case study.
You see, that is why as value investors, when we invest in a business, we really try to understand the business deep now. Now, if I think there was a question by Liu San, right? So Liu, if you put yourself in Tony Fernandez's shoes, right, because don't forget, businessmen are in the business for the long term. Okay, investors may sell next week or next month. They don't care, right? They can switch. They can switch to other stocks right away. But for the businessmen, they are stuck with the business. They have to grow the business now. Think like Tony Fernandez now. In 5, 10, or 20 years time, it's quite normal that there will be more competition coming onto the Malaysian airspace, especially ASEAN, because AirAsia operates on the ASEAN airspace, right? So in this case, and knowing that running an airline business is very tough because don't forget, year in, year out, you need to spend money, capital expenditure to buy planes. You need to spend a lot of money to service your planes. So these are very capex heavy business. Okay, but don't forget, on the other hand, you have been running AirAsia for more than 15 years and you accumulated a massive database of the passengers that fly every year in year out using your airline. So how do you monetize this asset? Okay, so if you think about business models like Uber or Grab or Airbnb, right? Basically, they are very asset light. They don't Uber does not own a single car. Airbnb does not own a single property. Okay, so that is the thinking process of Tony Fernandez. What he wants to do is he wants to strip off all these heavy assets. So instead of owning these assets, I sell it, get the capital, then I lease back these assets, the planes. Now instead of a capex, now it becomes an opex. Now what? So what can I do with the extra cash flow, with the extra money that on hand after I sell my planes? I can invest in other business that do not require so much capital, but can have much more profitability compared to my airline business. And that is exactly what Tony is doing or is trying to do. In fact, he set out a Red Bit Ventures RVB to specifically oversee this digitalization of the business. Yeah, so they invest in things like Big Pay, your Our Shop, which is an online shopping. Lately, he is actually focusing a lot on the OTA, which is the online travel agency via Asia.com, so on and so forth. So I don't know about you. Again, like I said, this is a very personal choice. I agree with Tony Fernandez's strategy to actually, in a way, revolutionize the business model Asia from a capital heavy business to an asset light business. In fact, personally, on my personal financial planning, I'm actually also adopting this model.
So you sell your Ferrari.
I don't have Ferrari, but I'm thinking of at least a lot of high net worth people are doing that. In fact, they are leasing their own homes. The homes that they buy is the property they buy is for investment.
Even the Ferrari they drive is leased. Maybe.
Well, high net worth people normally they use other people's money to own, to generate cash flow. Yeah. So this is something for you to think about, Liu San. If again, like I said, this is very personal. So if you do not agree with this strategy, it's okay for you to step away. Or if you're AHL shares and you do not agree with this strategy, you can sell. All right. Even before the AHL dividends X. For me, we will be trading. Thank you very much.
Yeah. So hi. Is there a difference between this passive portfolio strategy and dollar cost averaging in mutual funds?
Yeah. Okay. Yes. You see, the DCA method, which I explained just now, which is the equally distributed strategy, right? The criteria is based on the price. So you see, there's a specific price. I wait for me to deploy the capital. But the deployment, the magnitude of the capital, the allocation is fixed. So that part is like the DCA. But in mutual funds or unit trust, the DCA is employed differently. So instead of price as an anchor, they use time as an anchor. Meaning every month, regardless of how much the price, I set aside 5,000, I will buy 5,000 ringgit worth of unit trust or mutual funds based on the market price then. I don't care what price is it, it's based on time. So it's a same concept but employed differently. I hope I answered your question, Jimmy.
Yeah. Parameters a bit different. Okay?
Yes.
One is time, one is price.
Yeah.
Okay. So should we give a discount on the allocation based on the current bad market sentiment?
Jia Hong, I think I know Jia Hong is one of my members, one of my students. Yeah. So, should we give a discount on the allocation based on the current bad market? So I'm not sure I understand your question
I think
correctly.
maybe should we instead of allocate 10% for market, maybe you should allocate 5%? Do I understand correctly?
If you are worried, it's because again it's your plan, so there's no right or wrong. As long as you know what you're doing, your plans are just justified properly, you can go ahead. But again, speaking from my experience, every time I change my plan, is when the market turns the other way.
Go up.
Yes, many years ago I was invested in DG, right? Because so much bad news in the market, right? I said, I got scared. I'm also human. All right. So instead of maintaining my GTD, I actually pull my GTD down. What happened in the end? I didn't execute my trade. The share price shot back up. Yeah. So again, it depends on your personal risk and how much you understand the business. Jia Hong, how about I answer your question?
Okay. So with a student with a saving of about 300 ringgit a month as a student, what would be the recommended amount of cash in the portfolio in your opinion?
Again, this is a question from Ka. Again, okay, Ka. Well, first I have to ask you what is the objective of your portfolio. Now, if it's for long-term portfolio, right? Start today and your inception. Okay, how much cash you need to put aside today, right?
Like he save 300 a month. How long should he strike? Should I save until 30,000 or should I save until 15,000? So
again, there's no hard rule to it. It depends on the market. So say you may save until 1,000 and suddenly the market crash. Yeah, should have saved more, right? Okay. Sometimes you save for 1 year, there's no opportunity, so you just got to wait. But normally, so let me try to understand the question. What would the be recommended amount of cash total for the portfolio in your opinion? Again, there's no right answer for this. Let me give you a real case study. I've got a friend who started her portfolio at 2,000 ringgit in 2012. 2,000. 2,000, to tell the truth, you can't buy a lot of shares, right? So the key here is you set up an account, you put 2,000 ringgit, doesn't mean that you have to execute right away. So what happened with this friend is every month when her salary comes out, I give her a call. Hey friend, your salary is out, right? It's time to save money. Okay, so that's what she has been doing religiously for 2012 to 2018, about 6 years. She has accumulated 66,000 ringgit of worth of capital. Imagine if she had spent away those money, right? Now, this 66,000 has been helping her grow her money at about 8% per annum. Her KGA was 8%. So again, this is 8%. Is it a lot? No, but is it better than putting in savings? Definitely. Okay, so to answer you, there's no minimum amount to start, but you must always start sometime. All right.
All right. So other than stocks, what is your thoughts of replacing some of the stocks exposure in portfolio with fixed income products using the same method? If you have, then maybe you can suggest other products we are able to access in Malaysia that we can allocate for.
So, wow, this is a very advanced question by Yi Xiangdong. Yeah, I'm sorry. Actually, my expertise is only in one asset class, which is stocks. So I don't know what kind of other products you're looking at.
Fixed income.
Fixed income, no. Okay, bonds normally, unless your portfolio is sizable, it may be a bit challenging for you to go into fixed income bonds. Now, okay, maybe you can look at fixed income type of stocks may be like your REITs, because REITs again, it's not really like a business. It's a special purpose vehicle that is set up, to manage properties, and then your income is rental. Then the management takes a cut and distribute the rest. So this is again as close as possible to a fixed income strategy, but still on equities. So I mean, you may consider to look at REITs. Yeah.
Okay, but that's more dividend based.
Yeah.
Okay. So the last question we have.
So we have time for one last question.
Is regarding the M.A.S strategy that I mentioned just now. Is it similar to a limit buy order?
Wow. Actually, to tell the truth, I don't really know what is a limit buy order.
I mean, you buy below the market price.
So, but the market price changes every day. This is why I'm sorry, Fen. I don't. First of all, I don't really know what is a limit buy order, so I don't think I can answer your question, because I'm afraid if I give you the wrong answer, I may mislead you.
Okay.
I'm sorry about that. But let me get back to you if possible. I need to find out what is limit buy order first. Okay.
If I may take on these questions, I would say that the automation strategy that our speaker David shared today is basically about capital allocation, how much you should spend for this stock, and how are you going to execute it in a ladder kind of format, in a pyramid kind of way, where the big bulk of the purchase is done at the bottom of the pyramid. Limit buy order is just a type of order where you can use to do a a good till date. Okay? If you do a good till date at for below the market value,
Yeah.
that is a limit buy
I
order.
see.
So it's how you structure the
Okay,
limit
so
buy
so
order
so
of
in this
reference
case,
point.
I think limit buy order, the price is depending on the market price, right? Correct,
and
Anna?
below the
Below the market price. So here, we specifically set we already plan for the price.
Yeah. So the strategy teach you like what is the range
Yeah.
you should go for, how
Correct.
much you should allocate, should 10% here, maybe automation you should allocate 60%
Yeah.
of your capital there.
So in this webinar, I just introduced the concept. I actually did not touch on the details on say why we did 3 steps, why we did 90 cents, 80 cents, and 70 cents, why not 90 cents, 85 cents, or 83 cents. So there is again a whole new mathematics behind, which is very simple, but I'm very sorry I can't cover it in less than 1.5 hours. In fact, we actually spent about half a day to talk about this in our course. Yeah.
Wow.
Sorry about that.
It's quite in depth.
Yeah.
So, but anyway, that's a snapshot of what the concept that you learned today is.
Yes.
How you can structure your capital in such a very methodological way when you want to buy.
Yeah.
And when you come to sell, it's more like an art.
And it depends on your risk and your target.
It depends on your risk and your target.
Yeah.
Okay, so that is the conclusion of the webinar today. And we have more for you. Of course, join us on our next webinar, which is a Chinese webinar next Tuesday, where we're going to talk about cycle analysis and its application, but it will be done in Chinese, which is we call it 周期分析及其应用。Okay, 所以on next Tuesday we'll talk about this topic. If you want to learn aside from technical analysis, fundamental analysis, want to learn one more analysis, recycle analysis, but it will be in Mandarin. Please join us on our next webinar. All right.
It looks interesting. Maybe I'll sign up as well.
Sure. The registration link is here on the chat box. The speaker is Pauline Yong.
Oh, Pauline Yong. Okay.
All right. You know her.
Good. Yeah,
so
I know.
your friend.
I know Pauline.
Okay.
Yeah.
So please join our webinar. Of course, this is limited. Please enroll early. With that, thank you everybody for tuning in tonight. We have great response,
So
great number of
if our viewers have questions, they can welcome to email at alpha@spiralthinker.com.
Yes, please go ahead and email them at email David's team at alpha@spiralthinker.com. That way she'll get back to you on all the education content kind of question. All right. Thank you so much for tuning in. I know I appreciate you all for tuning in today, because despite it's like Raya holiday coming up soon, you all are tuning in today to invest in your mind. All right.
Thank you very much.
And have a great pleasant rest of the day. Bye bye.